Hi guys. Today we will analyze Walmart stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Walmart is a medium performer in the overall market. The short-term trend is negative. The long-term trend is negative. There should be more interesting stocks out there. Support level is around $136. The next support level is around $127. Resistance levels are around $142 and $146. Strong resistance level is around $152. The stock has an average volume of 10 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 3% per year, for last 5 years. We see that the average profit margin of the stock has been around 2% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 123% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Walmart Company: bad, average, and good. First scenario. Walmart will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 1%. Future profit margin would be low, 1%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $68. The second scenario. Walmart will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 2%. Future profit margin would be average, 1.5%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $110. The third scenario. Walmart will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 3%. Future profit margin would be high, 2%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $164. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 2.86. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Walmart, analysts forecast growth rate around 3% per year in next 5 years, and future P/E around 25. Again, I will use 3 different scenarios for Walmart Company: bad, average, and good. First scenario. Walmart will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 1%. Future P/E would be low, 20. In this case, the fair value of the stock today would be $23. Second scenario. Walmart will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 2%. Future P/E would be average, 30. In this case, the fair value of the stock today would be $37. Third scenario. Walmart will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 3%. Future P/E would be high, 40. In this case, the fair value of the stock today would be $54. As you can see, today the stock is overvalued, $137, even if we expect the company's high performance in future. Both the profitability and the financial health of Walmart are neutral. Future growth will be small. Nothing too spectacular is happening here. And the stock is currently overpriced. I may consider opening a small position of the stock if it drops below $100. Company's strengths. Walmart is the world's largest retailer. The company has three segments: Walmart stores, which accounted for about 66% of sales, Sam's Club, which comprised 11% of revenue, and the international segment, which generated 23% of sales. 90% of the U.S. population lives within 10 miles of a Walmart store. Despite the macro and industry challenges, the inventory position is up 11%, stores and fulfillment centers are well staffed, and the company's price position remains strong. Walmart's past investments helped it to win business and generate strong cash flow during the pandemic. The company's offerings of furniture, electronics, housewares, hardware, garden supplies and toys make it a potential beneficiary if consumers continue to shift spending during the pandemic. The company's finances are top tier within this sector, the store environment is improving, and e-commerce capabilities are growing. The company is also growing online sales by third-party vendors. Risks. Walmart faces intense competition from Amazon and online retailers. All discounters historically have been hit harder by price hikes for gasoline and other commodities, which disproportionately affect the discretionary income of lower-income consumers. Currency fluctuation is an ongoing risk. A strong dollar hurts earnings as foreign profits are translated into fewer dollars. A weak dollar might be a bigger long-term threat because it could cost Walmart more to purchase the large number of items it imports from Asia. Deflation can also be a challenge as it can reduce unit revenue on selected products such as groceries. Walmart will show a small growth in revenue. The revenue will grow by 3% on average per year. The EPS will grow by 7% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.